Good afternoon, everyone, and welcome to the last session of the day and the most popular session of the week overall, with more than 500 of you tuned in already. The popularity of this session may reflect the fact that the last few years have been halcyon days for Baillie Gifford, and its flagship trust, Scottish Mortgage, is an example of that. As growth has come to dominate the agenda, Edinburgh Worldwide is perhaps not as well known as its big sister, but has won a strong following among savvy growth investors who see it as an attractive way to gain exposure to the best that firm has to offer. Investing in a broadly diversified portfolio of companies which the manager believes are small relative to their potential size, and that may mean they're not small in absolute terms, the trust pursues an out-and-out growth agenda under the manager who leads the Baillie Gifford Global Discovery Strategy. This strategy, which underpins a number of funds and trusts in the stable, aims to identify interesting but immature businesses that could be multi-decade holdings for the firm's managers, and has been described in the press recently both as Baillie Gifford's ideas generator and its secret sauce. We concur with this view, and we awarded Edinburgh Worldwide a growth rating in January in recognition of its track record delivering solid growth, and I'm very pleased to hand you over now to the manager, Douglas Brodie.
Thank you very much, Pascal, and hello everyone. Hope everyone's well. Hope everyone's keeping sane in this still very odd environment that we're in, but look forward to telling you about what we're up to with the Edinburgh Worldwide Investment Trust. So in terms of today's presentation, I've got a little bit of scene setting. Hopefully it might come across as a little bit of a rant at the start, but it is a good lead into, I think, our approach at Baillie Gifford and the opportunity that we see in the smaller companies area, which we think is very real and actually quite misunderstood by many investors. So if you engage with media in pretty much any format these days, you'll probably encounter something like this, a never-ending stream of news, usually telling you that something important, often negative, is happening. It tends to be pretty primitive. It pushes you to have a reaction. It reinforces any biases that you may have. And unfortunately, the casualties in all that really are patience, perspective, and I would say positivity at the end of it. It is a very primitive sort of approach that it has, but arguably the financial world has had this problem long before media, long before rolling news, long before fake news. So for the best part of 40 years, you've had armies of analysts at investment banks micro-analyzing tiny trends in businesses, companies spoon-feeding guidance to that audience, the notion of beating consensus over ever tighter periods, and a whole exercise that's really sort of shifted right of the decimal point, and it's ended up with something that's become increasingly short-term, increasingly reactionary, and it's arguably pushed finance down a route that's probably served its own needs more than it has its clients. Much like what we've seen recently in media and politics, increasingly meant that investment has become, I think, ever more distorted, somewhat abstract, and actually quite removed from its core purpose. And its core purpose is actually quite simple, particularly that equity investing slant of investment. Stock markets exist to provide capital and support and engagement for companies to develop ideas, and really the fruits of those ideas flow back to investors through returns and back to society more broadly through progress. And inherent in that is investors having to engage in that task of predicting the long-term future direction of companies and industries. That can be uncomfortable. It takes you out into that sphere of uncertainty and projection, but it is unavoidable. You cannot cheat that process. You have to look through the noise to the companies that will shape the world, and you have to do that in a way that aspires to create long-term wealth at the end of it. It's not a game of trying to outsmart other investors. It's not a game of you versus the index. It's not calling cycles. It's not faddish valuation methodologies that come and go. It's recognizing that industries and society undergo profound change over decades, if not multiple decades. And while some of the things on the screen there do feed into that, they don't ultimately define that. Human ingenuity, entrepreneurial flair, technology progress, and innovation are much more key contributors to that. So you need an investment process, an investment philosophy that embeds that stance, one that emphasizes long-termism, one that emphasizes patience. And if you do that, then growth and the compounding effect of growth really can come to the fore. Now, why have that approach? Well, really the evidence very much supports that as a stance, particularly the growth aspect, which I go into on this slide. So what we're exploring here is that really robust correlation between long-term growth in businesses, be it sales, cash flow. In this case, it's actually done on earnings growth, EPS, and the correlation of that with share price performance. And what we've got here is a 25-year global analysis across equities, breaking that 25 years up into rolling 5-year periods and bucketing companies into a fast-growing bucket, which is on the right-hand side, and the slowest growing bucket on the left-hand side. And the growth rates are actually markedly different between the fastest growing and the slowest growing, as you can see. And when we actually delve into those buckets and look at the share price performance as evidenced by the relative returns in purple in that line, there are very non-trivial differences between companies that grow well, end up performing well in share price terms, and companies that do not grow and arguably contract, perform poorly in share price terms. And this goes beyond sort of cyclical periods. I don't think there was a single 5-year period where this pattern didn't hold. So in the short term, look, I get it. There's multiple things that drive share prices, news, technical factors, etc., etc. But in the long term, it is actually simple, arguably beautifully simple. And your job as an investor is to try and get ahead of that, predict where that growth is going to come, and position accordingly. The other thing that as time horizons have come in and contracted, arguably the bulk of the investment community overlooks the importance of investment asymmetry. And you may have heard some of my colleagues speak to this, and this heavily feeds off the work of a Professor Hank Bessenbinder in the US, who's looked at the long-term returns of equities, primarily versus treasury bills as a proxy for a sort of a risk-free rate. This is actually the second phase of that analysis. This is looking on a global universe of stocks. The original work was done on US stocks. And what you're looking at here is over a 30-year period, really the dispersion of returns and the evidencing that a very small percentage of companies were largely responsible for the vast bulk of the wealth created. We're talking here about a fraction north of 1% of companies responsible for the entire dollar creation of wealth over a 30-year period. The other 99% of companies just effectively netting out. Now, there's lots of sort of sub-analysis you can do on this, and I very much accept that there's arguments around active management and passive management that you can kind of draw from this. But for me, the crux here is that it speaks to that long-term distribution of returns being broader than people typically believe, and the compounding effect of returns as they build being crucially important to that long-term process of building businesses. It also speaks to the dangers of some of that sort of modern mantra that you see in stock markets: mean reversion, rebalancing, obsessions with volatility. If you anchor to those metrics, you tend to miss this much bigger picture. And as striking as that picture is, it arguably is, I think, only half the story, because it tends to underplay the significance of getting into these special businesses early. And maybe that's the construct of doing this around a kind of dollar value wealth creation, which is a slightly alien concept for investors. Investors tend to think of percentage returns, not dollar value created. And I think if you do that, the ability to drive returns off smaller businesses growing off a smaller base is very real. Think of the example of, that you create the same dollar value in a company growing from $1 billion in size to 50 billion, and one growing from 50 to 100. But one's a near 50x return and one's a 2x return. So if you can get into these businesses early, it tends to be terrifically powerful. So maybe just to draw that together, growth matters, picking great companies matters, retaining those companies matters, and everything else is largely noise, and you have to filter it accordingly. Why listen to us, and in this case me on this particular day? Well, I may be preaching to the converted if some of you know Baillie Gifford and our approach, so apologies if that is the case. But we have a long history of doing growth orientated equity investing for well north of 100 years now, and through a large part of that time, investment trusts, close-ended structures have been recognized within our business as a primary route for doing that, and all the advantages that those structures have. We are a multi-generation partnership. I think that is terrifically important. We act like business owners when it comes to making our investments. because we are business owners. We apply a similar time horizon to how we think about our own business as to how we think about the investments that we make. And we think that gives us an interesting cultural advantage, and we reinforce that through having a very open discussion, debate-led environment where you can get friendly challenge from your colleagues. We develop our talent typically internally, and we have the luxury, I would say, of doing that in Edinburgh, which creates the time and the space for good idea generation. And I think these points are genuinely important because they may sound soft, but when it comes to just getting the structures and the incentives and the alignment right, I think that is terrifically important for long-term asset management. Now that's probably a good point to sort of move away from what could be a bit of a rant into a bit more forward thinking. How is the world evolving, and what are we doing as investors within it? So I often think if you ask people to sort of give their own view on technology and progress, they tend to have this sort of deceptive view that it's quite, it progresses, but it's quite linear. It's quite obvious how we all now have iPhones, how we all use the internet. It's only when you actually step back and just observe that rate of change and how radical it's been over the past couple of decades. Smartphones becoming ubiquitous, data generation from a whole host of devices, intelligent ways of spotting patterns in all that data, leading to insights and automation, machine vision. You can now sequence and manipulate DNA with comparative ease. That has huge implications for medicine and unlocking novel targets and therapeutics. There's this ever expanding sort of toolkit of technologies that companies can now tap into, and invariably much of that toolkit is digital in its origins. I think the important point is to don't view these things as existing in isolation. These toolkits are constantly colliding, and they tend to combine in very synergistic, modular ways. And as a smaller business investor, I think that is terrifically important to what we do, because you tend to find it's smaller, more nimble businesses that are the ones experimenting with these technologies. They don't have the legacy business to worry about. They can just get out there and experiment and iterate. And they tend to be the ones that come up with the most interesting combinations of technologies. I'm thinking here in terms of companies in the portfolio like Oxford Nanopore, so a core competence in semiconductor technology, combined with clever protein chemistry, combined with sort of AI software to decode the signal. That's a unique combination of skills, and you see something similar with SpaceX, another one of our Unlisted holdings, where you're looking at a combination of material science, communication type structures, or automation to do the automated landing of these craft. These are unique combinations, and it's allowing companies to build truly audacious products that even just sort of 5-10 years ago you would have you'd have questioned whether or not they were possible. So in sort of industry speak, what people would often label what we do on Ewip and within the discovery team in Baillie Gifford is smaller company investing. Small cap would be the sort of typical terminology, but we actually think it's much more than that. So the conventional way of doing smaller business investing is, I think, to sort of over compartmentalize it. You break the world up into regions, and then here's the small cap bit, here's the mid cap bit, here's the large cap bit. That's fine, but it tends to sort of define the opportunity the wrong way round. The most interesting businesses don't want to be labeled regionally. They think about themselves globally, and they don't want to be labeled small because they have the ambition to become much bigger. So from the outset, we set out our stall to really try and unearth those high potential businesses, that small subset that they are currently small, but they have the ambition to become much larger. They want to be the winners of the future, and they want to reshape their industries. That is not most companies. There is a bit of a dirty secret in smaller business investing. Most businesses are small because they can't become big for a host of reasons. That their product may not scale, the management may not have the bandwidth, but we don't sink any time into those businesses. We want to find the special ones, and we want to retain them. And we've deliberately structured what we do not to be forced sellers as those businesses grow and trigger a market cap limit. So we look for businesses typically below $5 billion in size, but we aspire to own very large, very successful companies. In that way, what we think we do is, in essence, it's a pure form of growth investing, but it seeks to maximize the advantages of that by looking for ideas when they are smaller, when they are below the radar of mainstream investors. We accept in doing that, we will engage with some businesses that are young, they are raw, they will be labeled by some as immature. Now we view that in a positive sense, but these businesses have a lot to live up to, and you tend to find, if you can see the beauty in that, some of that will come good. Stock markets tend to struggle to do that. They crave certainty, and they tend not to reward businesses for that longer term potential. Why do we have that approach? That you can unlock through pursuing that from a sort of idea generation start point, and the ability to run your winners and not be forced sellers. So what we have on this slide here is a cumulative holding period analysis for every company that we've held within the Edinburgh Worldwide Investment Trust since I took over running that fund back in 2014. It tells an awful lot of stories. There's the right-hand side, which is the inevitable companies that don't work. We don't like that, but we accept that occasionally you do engage in companies where your hypothesis just does not play out. And almost having a culture and an approach on the team that accepts that and deals with it is key. Because if you don't have that, if you don't have the tolerance of that, you'll never unlock the left-hand side. And it's the 30 to 40 companies on the left-hand side of that chart that have delivered the vast bulk of the returns of the Ewip portfolio in that time, even to the extent that pretty much just one of the stocks on the left pays for the entire tail of businesses that don't work. It's very sort of subscale on this plot, but there's little purple bars underneath the top 10 companies on the left-hand side. That's really trying to capture just the drawdown effects, that almost sort of peak to trough loss that you have to tolerate in your ownership of these businesses that end up doing phenomenally well, but there will be inevitable periods where the stock market takes 30, 40, 50% off these companies in a period of time, and that's how you get tested with the long-term ownership of these businesses. So what are the characteristics of these businesses that we look for? What are the traits as I sort of explore on this side? Well, to keep it simple, we love businesses that are out there trying to solve very large problems. These are companies using that technology toolkit that I talked about earlier on to innovate, to disrupt, to be pioneers of new ways of addressing, in what is often cases, old problems. These are mission-led businesses. They are not your typical small business, which is trying to plod away with a commoditized product and a generic offering with lots of companies doing the same thing. The bigger that problem, the more ambitious the company, the more likely we are to sink time and resource into understanding it. These are the companies that can make a difference, both in terms of how the world will look in 5, 10, 20 years times, but also they are the ones that we think, if they get it right, will reward the patient long-term investor. So good examples of that in the portfolio currently, we have holdings in Ocado, which is trying to solve the problem of doing online grocery at scale. We have examples with Zillow, which is trying to streamline the housing transaction system in the US. We have a business called Market Access, which is trying to drag forward bond markets into almost like an exchange type function where liquidity and efficiency really come to the fore and benefit that market. So these are typically often very large pre-existing markets, but these are the companies trying to re-architect how those industries may look. We spend a lot of time thinking about the management, because management clearly link very strongly to that identification of the problem and then the ability to come up with a solution to it. You're really looking for a sort of an alignment of time frame and goals with the people running that company. It probably comes as no surprise that about 2/3 of the businesses that we invest in still have the founder attached in some capacity, and I think that speaks to the founder often being just instrumental in setting that vision. We like companies where there is an emerging competitive advantage. Now, those that know Baillie Gifford well, you know we spend a lot of time thinking about edge and competitive advantage. It's crucial to do that as a long-term investor. That ultimately creates the essence of sustainable growth. I think we have a slightly different take on that from our business stage of investing. We're more looking for companies that have the ingredients in place, that as and when that company grows and progresses, that competitive advantage becomes hardwired. But in the earlier days, it's more the ingredients that are contributing to that. So maybe bring that to life with an example. We've been long-term holders in Tesla, which we bought, I think, best part 7 years or so ago, just as the first cars were coming off the production line. And what intrigued us there was you began to see sort of hints of edge in battery technology. You still had them to scale that, but you also saw clear edge in just a pure ambition to develop a product that others didn't really want to do. The incumbents didn't almost want to believe in electric vehicles. And here was Tesla with this sort of mantra of, this isn't just going to be a good electric vehicle, this is going to be fundamentally a better car, and evidencing that with some of the reports that came out in time. So it maybe speaks to how when you go early in these businesses, you have to be a little bit more forward thinking when it comes to edge. And the last bullet point there is probably what we've learned most as we've gone through this exercise over the past 10 years of running money on this type of remit. It's terrifically exciting if you can find businesses with an inherent scalability to what they do. And by that, I mean the ability for growth almost to become easier as a business grows. The key unlocking points that a business gets to, and then the next level becomes easier. Now that's phenomenally rare. Most businesses hit sort of anti-scaling points, either bureaucratic or distribution, geographical points where it becomes hard to navigate. But increasingly what you're seeing with real network effect driven businesses, or perhaps sort of platform-led businesses, you can really flip those arguments around scalability, and unlocking becomes a key factor in progressing that business to the next level. I've touched on market access. I think that's a very good example of that. So approximately 20% of investment grade bonds in the US trade on their network, and growing share in terms of high yield bonds and other bond assets. It's almost at the stage now where it's functioning as an exchange, and quite quickly you would expect more volume to migrate towards them if they become the home for doing that. We have many healthcare businesses that I think represent very interesting platform type companies, where a core competence that company has honed and got working can now be pointed in multiple directions. Another aspect with Edinburgh Worldwide, which I was keen to explore, is the unlisted holdings. So this is maybe a key differentiator of EWIT versus the global discovery product, which I run, which is the pooled fund variant that follows a similar remit. Now, we only have the unlisted holdings within EWIT, and we've been scaling that out over sort of 5-6 years now. Currently, I think we've got 10 names in the portfolio, and some late stage work ongoing on several other names. It comes to about 5% of the fund currently, and we've got flexibility to go up to 15%. But maybe just to pick out a couple of the companies here to give you a flavor for what we're accessing with that unlisted side. SpaceX is a company that I'm sure many of you heard of through sort of monitoring what's been going on in terms of space exploration and the launching of satellite constellations. Really a terrific example of using that technology toolkit to drive down costs, provide that as an outsourced service to others in the industry, but also using that internally to build constellations of low Earth orbit satellites. I've touched on Oxford Nanopore. From a UK perspective, I think it's phenomenal what they've done, building out a form factor of device for DNA sequencing that has an ease of use and a utility that perhaps represents, I would say, in many ways, that the future of what DNA sequencing might look like. It's less big machines in labs, and this could be more distributed DNA sequencing as and where you need it. Maybe to pick out another one, Achille. I think this is phenomenal what this business is doing. It's computer games that have embedded algorithms that can stimulate certain parts within the brain, and it's well known that in certain cognitive disorders, bits of the brain need a bit of stimulus to get them going, and ADHD and perhaps even depression and some of the symptoms around that relate to areas of the brain that you can stimulate through it now in non sort of drug formats through gameplay. Hopefully that gives you a little bit of a flavour for where we are with the unlisted side, and happy to take questions on those companies as we come towards the end. But maybe in terms of the Ewip portfolio itself, here's a bit of a snapshot for where we are. This is really the output of that bottom-up stock picking process that I've talked about. Currently north of 100 young, immature, high potential businesses, businesses that we genuinely aspire to own for the long term, and where we are deeply intrigued and in many cases fascinated about what these companies may grow into. Many of the companies in the fund will not be household names, we know that, but our hope would be that in many years' time, some of them do progress to being that. And really on the right hand side, I try to pick out some sort of themes in terms of business areas that these companies are active in. You tend to find when you come down that market cap scale, you can access areas of innovation and progress with a purity that you just cannot do if you engage in trying to pick these businesses higher up. And maybe just quickly touch on the turnover, 7% turnover. Consistent with a long-term approach, it probably understates how much the portfolio can change in a given year. Just think of that distribution of returns that I talked about. So there's us actively changing the fund. There's also the ideas doing that sort of filtering for you between the winners and the losers. And just I was going to close out on one more slide, which is the EWIT top 10 as at the end of January. Again, some names you'd be familiar with, others that you probably aren't. Happy to take questions on any of those names and illustrate those with examples. But maybe as we're coming towards that sort of half-hour point, I'll probably just touch on the chart on the right-hand side, which is the long-term performance of the EWIT NAV being handsomely robust and particularly strong over that last sort of 12-month period. Now, that's not because we predicted the pandemic. It's not because we guessed how the world would adapt. It was largely driven by the strong operational performance of companies that we have owned typically for a number of years. And at the risk of overgeneralizing, but I'll try to do it. Many of these companies represent an alternative to an existing incumbent solution or an established way of doing things. And maybe what we've learned in pre-COVID times, that alternative had some resonance, but it was not the default primary route in which people wanted to engage with that industry or that area. But the companies that we like, at their core, they're trying to develop a proposition that is better and cheaper than what came before it. And they really strive and they really work towards that. And I think we've started to see in that COVID area that there's this enforced adaptation, and the minute you put constraints around a system, either businesses or individuals are forced to adapt. And what you've probably seen is that many cases of almost like an unlocking and an awakening to the fact that there are these probably digital-led, better, cheaper, more scalable, more efficient ways of doing things. And that's really risen to the fore, be it in online grocery shopping, in telemedicine, and just the melting of inertia for people to engage with a channel like that. And that's hugely important, because once you get to that better, cheaper point, it becomes very, very hard for others to catch up with you. You tend to find the incumbents are actually the wrong way on. As a digital provider, you're constantly going down the cost curve as you become better and cheaper. As the incumbent, you probably go the other way. Think how automotive companies are having to invest to get around ever tightening sort of emission regulations, how if you're a traditional grocer, you're having to run multiple distribution channels and build an online system. Your costs go up, whereas the digital providers instinctively drive down their costs. And if you can get to that better, cheaper point ahead of others, you can then do things that others can't do. And we've seen this pattern in many of our companies where we've owned them for a sort of like a 5-year period while we were testing that hypothesis. Could they get to a proposition that was better and cheaper? once you get to that, it's probably the next 5 years that's actually the more interesting. That's when you can drive your advantage home, and it's when you can do things that others can't do. And I think many of the companies on the left-hand side are either in that point or tantalizingly close to that point. So I was very keen to leave lots of time for questions. We tend to find this as a strategy that people like to engage upon, so I don't want to sit here and witter on too much and eat into that time for questions. So I'll probably hand back to Pascal at that point.
Thanks, Douglas. We've got lots of questions, so good choice. There's an obvious sort of first off question to start things going with is talking about the low interest rate environment and the effect that's had on equity returns. Should interest rates rise, do you see that having a major effect on what you do? And something tied into that is the kind of growth value cycle. Obviously, growth has been in your favour and in Baillie Gifford's favour generally, given that it's a growth house. Should the cycle turn, where does that leave you guys?
Yeah, I'll take the interest rate one first. It may sort of morph into the second one as well. Now, yeah, from a fundamental basis, if you think about our companies, they tend not to be geared, so they don't have a debt risk exposed to rising interest rates. But I'm not sure that's where the question was going. People will sort of probably be thinking more about discount rates and long-term value of future cash flows. We are probably much more interested in how these companies build those cash flows in the future than trying to second guess exactly what is the appropriate discount rate for that. I often think I have the luxury of trying to pick stocks versus analyze deep economic cycles, because picking stocks feels easy compared to analyzing micro and macroeconomic trends. So it's one we'll see. I mean, I kind of hear the arguments around potential sort of near-term inflationary pressure. How does that play out in terms of interest rates? I must admit, as someone that sort of observes so many technologies that are fundamentally deflationary as they come through, I don't think anything structural has changed in terms of the outlook for inflation. That there may be sort of near-term supply-demand mismatches around that, but I'm comfortable with where the companies are and what they're doing in the environment they are currently operating in. To the point around growth versus value, I don't want to sound sort of flippant about this, but does business building and growth equity investing ever really go out of fashion? There are stock market cycles that sit on that. I kind of get that. But business building feeds off technology, it feeds off innovation, it feeds off entrepreneurial flair. And when you think back to the arguments that I was making earlier around the tools that companies now have to work with for that, you're arguably in a sort of golden age of innovation and business building that savvy entrepreneurs can use and build great businesses. Now, I don't think that ever goes out of fashion. Now, there will be stock market cycles on that, but if you approximate progress with growth and value with theoretically stable cash flows, I think it's probably been proven fairly recently that value is probably filling up with businesses that might be structurally challenged, and that's a risk. Now, I'm not making that as a statement, but that's a certain theory that could be out there.
Thank you. There's a fair few questions have come in about your approach to finding stock out there in the world and kind of finding the stocks that eventually are going to become the big rainmakers, and also whether you will invest in stock which is unquoted, and what is there a limit on how much of those stocks there are in the portfolio, and also whether you will invest in things which are not yet profitable. And again, whether there's a limit on those.
We have a 15% limit on the unlisted portion. Now, that in theory that can go above that, but we can't actively take it above that through putting new ideas in. The pre-profitable pool of companies, we will very much invest in companies that are pre-profits in certain areas. If you want to go into early stage healthcare investing, you almost by default have to go into pre-revenue businesses as well. So probably typically in the past, we've had sort of 30% or more of the businesses in pre-profitable states or around about break even. I haven't done the analysis recently. My hunch would be with the new ideas going in, it's probably nudged up a little bit. But we are investing in companies that are building for the future. We've actively encouraged them to reinvest the cash flows from those early product sales and variants into building out the proposition for the future. How do we find these ideas? I think was the sort of opening one in that. It tends to be really varied. There isn't a nice, neat template for all our ideas come down this channel. It's employ curious people who are interested in this type of activity. They want to understand how the world works. You don't want them operating as experts. We all on the team and across Baillie Gifford generally operate as generalists, but probably with biases as to where we like to look. That way you can have active challenge and active debate with your colleagues. You can't have that if you're the self-appointed expert on a tiny area that other people don't know. So we recruit diverse. We bring those people in. We get them to buy into that philosophy around what we do, and then we point them out there into that big bad world and say, go and find these ideas. And everyone has their own way of doing that, and every holding has its own sort of unique genesis as to how it came about.
Yeah. I think part of that question as well, an extension to that question is whether do companies come to you in great numbers, or is it all about you going out there and finding them?
Got you. Typically on the listed side, it's more us going out there and finding those companies. Now the listed side probably approximates into several tens of thousands of companies as the universe. So you have to be quite proactive at doing that. There is a different dynamic on the unlisted side, where more often than not, it's an inbound inquiry. Now then you tend to find there's so many of them that you have to go through a sort of fairly strict filtering process as to which ones you actually want to work on. Sometimes it's a combination of both. You're sort of interested in an area, you do a bit of exploring, and then you find a company and there's an engagement. But yeah, there is a different dynamic, probably in terms of how those ideas first come into knowledge. How you then work them up actually is quite similar. It's not a different process for analyzing an unlisted company versus a listed company. There's a due diligence requirement and a legal requirement, but the core task of the investing side is largely similar.
Great stuff. There's been a few questions about Tesla specifically, but rather than focusing on that company, just that company, I think the way to answer the question without upsetting any compliance people is, do you have kind of an upper limit on single exposures to single stocks? How do you know as well when you've got to the point where a company has delivered enough returns for it to be, to take profit on it? Where do you draw the line at chasing these things for multi-decades and kind of, the rainmaker type of stock?
Yeah, we tend to have a sort of soft stop at around 10% or so. I think we can, in theory, go above that with board permission, but that's kind of where we operate on a single stock level too. We have reduced the Tesla position towards the back end of last year and a little bit at the start of this year, largely driven by those portfolio diversification arguments. We don't have to your point of do we have a set sort of price target or the ability to make X times money before we're forced sellers of something. We don't think like that. The sell discipline, by which you'd say the exit discipline or the sell down discipline, is really the inverse of those traits that I talked about, with the overlay of how do those traits relate to where the valuation is. So think about the traits. Has this company or someone else solved the problem? Are the management team doing something you don't like? Is the edge that you hypothesize just not appearing, or is the edge now fully captured in the price? Or is the scalability not coming through or is understood? So it naturally flows in terms of how we get interested in something as to how we then move on from something. We don't blindly hold on to these businesses. If you think back to that, the asymmetry profile that I showed here. So I think if you take the top 40 companies on the left, would have been our best absolute share price return businesses. We've exited, I think, 6 of them and have reduced several of the others in quite material ways. So we do get to a point, hopefully after many years, when some of these businesses we will move on from. Now, I hope that some we own for another 5-10 years, but I can't sit here now and tell you which ones those are.
Thank you. Another part of that question, I guess, is what is there a very long tail in the portfolio of companies that don't contribute much, and kind of with those ones where it's not, the problem is not they've grown hugely and they're not delivered a huge amount, so you decide to take profits, but actually they've just done nothing, and you think maybe this is time to get out of that. At what point do you do that, and how do you make that decision?
Yeah, I mean that point would be sort of proxied by the right-hand side of that asymmetry chart. It's the businesses where you had an investment hypothesis, it didn't work. Could be for a whole host of reasons why it didn't work, but it probably was a company where it just didn't live up to that potential, either the product or the management or someone else solved the problem. Those companies tend to be on the way in, they are what you would describe as your most binary companies. You go in knowing there's a chance that this doesn't work, and you size that position accordingly. You're probably putting maybe 0.4, 0.5% of the portfolio into this. Now, by the time you work out that it isn't working, the stock market is probably telling you that it's not working. So quite quickly, the 0.5 is down at like a 0.1, 0.2. Where we actually prefer to have discipline around there is not sort of rigorously like setting stop losses and going, right, it's not working, the stock market's telling us it's not working, we move on. It's having the discipline not to just constantly top up these things because you're anchoring to a hypothesis that you think might still be valid. Now your hypothesis might still be valid, but have evidence around that. Don't just go, it was 0.5, now it's 0.1, we'll top it back up, and you repeat the same trick every 6 months. So we try and have a discipline of holding to just one chance to add to those binary investment cases, except that will mean there's a comparatively inefficient tail to the portfolio. But we've learned through doing this for the best part of 10 years that what drives returns is the left-hand side of that plot. And that's where we as a team obsess about, and periodically we do a sweep up in terms of the companies that don't work.
Thank you. A couple of questions on the kind of big picture and kind of macro stuff. Do you think having, I'm sure you've seen the talk in the papers about, sorry, my dog has just invaded my room. That never happens on Newsnight, does it? Okay, so do you think antitrust and kind of political pressure on tech companies is going to have an impact on what you do and on companies like Amazon, things like that, where there's growing kind of public dissatisfaction with the amount of tax, for example, these companies are paying, and has that factored into your stock selection?
It's less for us. I mean, you've got to bear in mind that we're trying to look for ideas below $5 billion in size in companies that are long on potentially with very interesting propositions, but that you wouldn't turn around to those companies and say they're a monopoly provider of a service where they kind of force their customers to conform to a certain way. And I'd love to think that in 30 years time, if what I say comes to fruition and we own the next Amazons, the next Googles, we are in that position of having to have that debate. But it tends to be less removed from the types of companies that we are looking at. That tends to be the sort of the domain of big tech and the real big multi-$100 billion platforms. It's not where we're active. There may be sort of second and third order effects of that, some of which may have implications for our companies. If you had a sphere of regulation in e-commerce that sort of clipped the wings of Amazon for sake of argument, does that then empower a host of other e-commerce companies that could come in and cherry pick certain areas? But it's not. I wouldn't say that forms a significant part of our thinking.
Thank you. The other one was talking about the geographical exposure. Two people have noticed that you've not got much in Europe, not a great deal in China. Can you explain why that is?
China's been creeping up, actually. So we've got a number of, I would say, very interesting ideas in China now. It's taken us longer than I thought to get those companies. We've got companies doing interesting ERP software for the Chinese market. We have what we hope will be companies that emerge as dominant in terms of a sort of Chinese biotech industry, companies on the sort of technology communications end. You tend to find in China so much of the pure technology sits within the confines of the three big internet technology giants, and is affiliated to those businesses. What we've maybe started to see that the last 3-4 years is that there is actually a wave of interesting, more startup-led businesses that sit outside that ecosystem. So I've been pleasantly surprised that we've seen more of that. Europe's always been a slightly tough one for us. We have a fairly pronounced skew towards the US, just because just that flow of funding and business building and entrepreneurial flair, and whether it's the VC money, access to the NASDAQ, there's just this whole ecosystem that is great for building businesses. You don't see that as much in Europe. The UK's okay at it. Europe tends to be worse still.
Understood. We probably haven't got time for these questions, but I'll ask anyway. I've got 2 more, I think, which I'm keen to get done.
Go for it. I'm fine. It's my time.
One is, can you sort of summarise the difference between this trust and Scottish Mortgage? Without suggesting how they should be used in the same portfolio. Just how they're differentiated.
The actual technical overlap in terms of stocks is modest. So I don't have that data to hand, but we can follow up in that. Particularly if you took out Tesla, the overlap is really very low indeed. I would say philosophically, they are working towards the same thing. Maybe they kind of approximate that smaller business investing through a more active unlisted component. That might be one area to think about it. But in time, I've always argued with EWIT that I hope and I genuinely believe that give it 10, 20 years time, this looks like an all cap portfolio. It will have a smattering of large businesses in it. It's just that we will have bought them when they are small businesses. So I think we take the growth ethos that is common to many Baillie Gifford strategies. You take the sort of the technology and the innovation and the founder ethos that I think is very strong in EWIT and Scottish Mortgage. Arguably, we're pointing that to a sort of active pool of companies lower down the market cap scale.
Thank you. And the last one, very simple, but I think probably an important one, is how do you use gearing in the trust?
We have a sort of gearing range that we tend to operate to between sort of 0 to 10% of assets. The trust has grown through performance and through issuance, so we may at some point have to think about the flexibility from a gearing perspective. The gearing can move around in terms of what we do from a holdings perspective. We have a number of unlisted ideas that we sort of ring fence some cash for currently, so you're always thinking about that. But I think it's an interesting structural differentiator of EWIT versus the OEIC. The bigger structural differentiator is obviously the unlisted businesses, and I think over time that's probably the bit that people should focus on as the advantage of the closed-ended structure of EWIT.
Brilliant. Thanks, Douglas. As usual, we'll do our best to answer any questions that haven't been answered or asked in this session. We'll get back to you after the show once Douglas has had a chance to see them. But in the meantime, I'd like to thank you all for joining us, and I hope you've got time to drop in tomorrow when we'll be hearing from managers running money which make the asset allocation decisions for you. These are going to be focused on outcomes like capital protection, equity income, ESG, and such like. All that's left is to say thank you very much, Douglas, for taking the time to talk to us today, and goodbye.
Thank you, Pascal, and thanks everyone.
Cheers.